Good day, everyone. Well, we've all heard of parallel universes. The many worlds theory proposes that every time one quantum state or outcome is observed, there's another world in which a different quantum outcome becomes reality. But if such exists, as has been postulated by physicists, certainly we know that while history may not exactly repeat, it does rhyme. So on a timeline, parallel worlds can exist. History does teach. The last major global pandemic was called the Spanish flu of 1918 to 1920. It was the second deadliest pandemic after the Black Death bubonic plague, with a global death toll of 2 to 3%. It broke out near the end of World War I. After the end of the war, demand temporarily dropped, pushing commodities about 5% lower. But by the spring of 1919, enormous foreign demand for goods pushed commodity and stock prices much higher. This demand was due to easy money rates left over from the war. The central bank had kept rates unusually low after the war because commercial banks had bought loads of Liberty bonds during World War I. But then the Fed stepped in and started to hike rates in late 1919 to quell demand and temper inflation, which had more than doubled since 1913. The price of commodities then peaked in the spring of 1920 after the Fed raised the discount rate to 6%, then quickly raised it again to 7%. Yet business activity had already topped earlier. What should have been a mild recession turned into a depression. Prices fell 22% between 1920 and 22, while bank failures soared. The Dow Jones Industrials lost about 47% from November 1919 to August 21, which is a 22-month period, while unemployment shot to 12%. The Fed was then pressured to lower rates, which quickly came down from 1921 to 22, and that spurred the Roaring '20s we've all heard about, which was a decade of economic prosperity like few others. The Dow Industrials then began a new bull in August of 1921. So in today's market, there are parallels to back then. In both cases, unusually easy money due to unusual circumstances was followed by aggressive rate hikes, which cratered markets. The recession then was unusually harsh. The 1920 to 21 bear was due to tight money. A couple of months after the Fed started to lower rates in 1921, the bear market found its major low and a new bull market began. But that said, just because the Fed starts to lower rates does not guarantee a major low in the markets. For example, this did not occur in the early 30s, even after the Fed started to aggressively reduce rates. And you can see from there's that earlier chart which shows basically that one. Yeah, that's it. So you can see that the Fed was struggling to take rates down since 1929 crash, and the market actually did not see major lows until June of 1932. And this also happened in 2000 to 2002, where the NASDAQ lost 78%. That was its largest decline ever. And that was despite the Fed aggressively reducing rates from 6% all the way down to 0.75%. And the reduction in rates before the financial collapse in 2008 also did not prevent that bubble from bursting, as there are many factors at play. So in these cases, there were massive market bubbles that had to be unwound, unlike the 1920 to 21 bear. And so the Fed had to reduce rates several times before the markets found their major lows. So today's market obviously sits atop a massive bubble, probably the mother of all bubbles, even when compared to 1929 or the year 2000 dot-com bubble. So it's possible that after the Fed is done raising rates, markets could still continue to fall. So at present, there's a few more rate hikes planned as the Fed seeks to lower inflation back down to its pipe dream of 2%. The markets are likely to stage deeper corrections before rates reach the 400 to 425 bips, which would result from the current CME Fed Funds futures predictions of 2 75 basis point hikes and 1 25 basis point hike by year end. Unemployment has yet to soar, but weekly jobless claims are on the rise, and history shows such increases in claims precedes jumps in unemployment. Corporate earnings are still soaring, but this too will correct sharply as the recession takes hold. The supply of homes on the market has also spiked, which historically coincides with recessions. Other metrics are likely to surface later this year or early next that show the recession worse than expected. The Fed will then likely halt the hikes, or if warranted, fire up the printing presses once again if another black swan crisis surfaces. Otherwise, because of high inflation, QE5 probably won't begin until late sometime next year. And this would, of course, eventually reignite inflation, which is unlikely to have dropped to the targeted 2%, but to the new norm that the Fed will set of maybe 4.5% to 5%. M2 will then start to reaccelerate after having dropped by an immaterial amount. So if we're to rhyme with the 1920s, all that said, the bubble will have to have unwound to some extent, which suggests materially lower stock and crypto markets. And QE5 will have to launch spurred by another crisis or from the recession turning out to be far worse than expected. Either situation could result in far deeper market corrections, such as during the early 1930s or early 2000s, even after the Fed started to aggressively lower rates. But we're at a record level of debt, double-digit true inflation on a global scale, interest rates still historically low, and the central banks are cornered. Inflation may be close to peaking in the US, as some have said, due to lower commodity, gasoline, and real estate prices, and poor buying conditions not seen since the early 80s, and the spiking inventory to sales ratio I've mentioned. And while inflation is likely to stay stubbornly higher than expected, the year-over-year inflation is likely to temper. And this may give the Fed room to hike less aggressively, which could create further dead bounces. But on the other hand, soaring rents hit 6.2% year over year, and that accounted for 40% of the increase in yesterday's core CPI. And therefore, it surpassed the previous 6.1% high in August 1990. And the core CPI was pushed to 6.3% versus the estimate of 6.1. Higher mortgage rates naturally are forcing people out of the home buying market. We also have the food index that jumped 11.4%, which was the largest increase since May of 1979. And that helped push the general CPI to 8.3% versus the estimates of 8.1. And today's PPI, it ran hot at the core, 7.3% versus 7% estimates. It was lower than the prior month's PPI of 7.6%, and that's due to falling energy prices. Goods costs slipped due to falling gasoline prices, while services costs rose. Fed funds futures readjusted their estimates of a 100 basis point rate hike to, last I looked, was 28% when the Fed meets later this month. And out to the end of the year, Fed funds futures are expecting a target range of 400 to 425 from the current levels of 225 to 250. So I don't think stock and crypto markets are going to stand for that. I think they're far more likely now to continue their choppy downtrends with these rate hikes in place. I don't see much on the horizon to rattle this potential. So maybe we get another Christmas crash on record again that comes once again in December, 4 years from the last Christmas crash of December 24th, 2018. Gil, how are you seeing everything?
Well, obviously, we're in a bear market. So some people haven't figured that one out, though. There's still some people out there who believe that this is an uptrend under pressure. Okay, whatever. All I know is, yesterday was a huge day on the short side. We were talking about this before the webinar, but I was getting this sense heading into the CPI number yesterday morning that everybody was expecting it to be below expectations. But I think that one of the things they're all missing is that they're all talking about, oh, gas prices have dropped and used car prices have dropped, but they don't understand that those aren't the main components of most companies or businesses' cost structure. Labor is. And we're mostly a service economy. I think, what, 80%, something like that, 70%. So, you know, if you're a service economy, okay, gas prices and used car prices may figure into inflation to some extent, but really the core of it is labor costs and everything associated with a service economy. And so that's why the core number came out 0.6 versus expectations of 0.3, and that's what sent the market down. So I just came in heavy short ahead of the number. So and so yesterday was a big day, you know, where I'll do like 25% in one day. And on that basis, now I take most of my profits. And this morning we get a rally, which is what I was looking for, because in a bear market, you'll tend to have up openings followed by down closes. So here we are. We've got an up open. What are we in? An hour and 40 minutes, or yeah, about an hour and 40 minutes into the trading day. So we get the NASDAQ is up, but the move is pretty muted here. Gap down through the 50, the 10, and everything else. And it's so oversold at that point that I do think you need to put in at least a couple hours consolidating that. Same thing for the S&P 500. So, you know, you had the 4-day rally, and that was that. So now what are you doing? Well, I'm stalking some things on the short side. And of course, if the market's heading on a new bear leg down, which looks to be the case right now, there's no reason to think not, then what I want to look at is my current leaders list. And these would be the stocks that have been acting the best most recently. So I've got them sorted here. There's only 40 names. I've got them sorted here by percent change on the day. So you've got things like Target Hospitality, leisure clubs and facilities. Not sure why this is rallying. I don't know if it's defensive or what, but it looks like it's on track for a pocket pivot, believe it or not. I'm not going to short that. Montauk Renewables just hanging out. Sigma Lithium. The lithium names continue to rally. That includes Albemarle, which is back at 305.32. And I want to remind everybody that if you're using the $300 century mark as a reference point for a possible short, if it breaks back below that, you always have to add anywhere from 1% to 3%, sometimes 5% above a moving average or an area of price resistance, in this case, the 300 level, to your stop if you're going to give it some room. Otherwise, I would just run it tight along the 300 level, and I've been back and forth shorting this one as it's bounced around. So we'll see how that plays out. But the other lithiums like Sigma Lithium continue to get extended on the other side. I actually think this is the best one, but it's also really thin, 471,000 shares. But it's not like I want to be long anything. I'm just watching these final leaders, because what will happen if we do go into another bear leg down and we break to lower lows on the indexes, then the tide is going to go out and drag all of these things out with it. That's my thinking. So I want to monitor them at least for potential short sale entries on initial late stage failed base type breakdowns. You can see definitely California Resources has broken down. Some of the oils are hanging in, some of the coals are hanging in, but some have also been plastered. Here's Albemarle. So you've got all these different reference points, the 300 level, the left side peak here. Right here on this side, you got this peak here, you got the left side peak over here. So, but it's continuing to move higher. So money is coming into those names, and probably because you have institutions that have been dumping things like Apple, Microsoft, Google, and Amazon are trying to figure out where they can hide. And so maybe they figure that they can justify buying lithium names to their board of directors, because all institutional money managers, generally, if it's a mutual fund or a pension fund, they have a board of directors that they have to answer to. So I always like to tell the story. Chris, you might remember this. We had one institutional client, and, you know, we're showing him all our stuff. And the guy's like, you know, well, I can't be up 100% in a year. And the simple reason was, he said that if he was, the board would fire him for taking on too much risk. So, right. So that's how these guys think. So, you know, you look at some things rallying and think, you know, why the hell is that thing going up? And that's probably why they're hiding. Okay. So that may be what you're seeing right now. They're going to get that done, and then maybe these lithium names come down. So I would just keep an eye on them. You know, be flexible. Don't be rigid. I think this market is crazy enough and odd enough, because I don't remember, maybe you do, Chris, but I'm older than you, but I don't ever remember a bear market where the Fed was raising interest rates. They're usually lowering, and it takes several lowerings before the market finally gets some traction and turns back to the upside. And in this case, it's so bizarre, they're raising. And yet,
Right.
go ahead. Do you have some?
Yeah, I was just this is why they're in a corner. They're absolutely cornered, and we've been saying this for several years. You know, if people have looked through our timestamp reports going back to 2000, I think probably
Yeah.
2010, you know, that this is not good, and there's going to be you know, the can only be kicked down the road so far, and now they've reached the end of the road. So now they're forced into hiking rates during, even though, you know, what they're calling not a recession is clearly a recession, and it's going to get a lot worse. I know they're using unemployment and corporate earnings as their metrics to say this is not a recession, but I mean, it's so obvious, and these guys are not dumb. They already know that we're going to be coming into some really bumpy waters ahead, because in every single recession that's ever happened, unemployment is always at the low end of the curve before it starts to soar. And you can see this. I've provided graphs on this showing, you know, decades of recessions. You know, it's just it's a very sharp like V, you know, where the unemployment goes all the way down to whatever 3 point some %, and then it rockets higher very quickly over the ensuing months once recession is in place. So I think we're on the cusp of seeing that. Probably, you know, in the next few unemployment reports, we're going to see it start to tick appreciably higher. And of course, corporate earnings are going to get dragged down. There's no way they can't not get dragged down. So it's going to be real rough sledding ahead. And that's what I'm thinking, you know, how far can this market correct? I mean, we've seen massive corrections in the past, and right now the S&P is off what, 30% or something?
27%? I don't know. Something.
Yeah, and so
30, around 30%, let's say. Somebody
right. So I mean,
us.
These markets could easily come off 50%
Yeah.
by the end of the year.
So
you know, it's
about 70%.
It's possible. I mean, we could see well, we won't get a 1987 style crash just because we have circuit breakers, but we could see some serious problems where I think Powell would probably step in during that situation and probably tell markets what they want to hear, like he did December 24th of 2018. So, but I mean, there'll be plenty of signs, and I think there's lots of shorting opportunity as a consequence, because everything is pretty negatively stacked against the long side. But of course, what we've also seen is the more obvious it is to short, the more people pile onto the short side, and you get these nasty short squeezes. When the market should be going lower, it will actually shoot higher, and that's happened a couple of times. So one has to be mindful. Basically, if the market is down too much and everyone's piling in, that's probably a dangerous time to short. But if we're coming off a dead cat bounce, which yesterday was perfectly timed. I mean, we had this nice little dead cat bounce for a few days, and then of course everything got hit so hard with the news. And I think what I'm looking for right now is potentially another dead cat bounce, or maybe some sideways action that shows there's no real buying interest in the major averages. And then that will be another short entry point, because I think we go another leg lower as a consequence of maybe trailing sideways for a few days.
Yeah, so we want to keep an eye on these last remaining leaders. So you look at the fertilizers; they were all on fire about 3-4 weeks ago, but you know, this one has double topped out. You have two left side peaks as reference points on the way down. Okay, now it's a late stage failed base. So in a typical late stage failed base, you'll bust the 20-day line, but then you'll get rallies back either up to the 10-day or the 20-day, and that starts to simmer down. Now we've got another rally today into the 20-day line, and then eventually it'll bust through the 50-day line if it plays out like a typical late stage failed base. So that's definitely one to watch. And the other ferts will move with it, you know, like Mosaic and Nutrien, but this one's easier to deal with because it isn't a concrete short sale entry spot. If you look at, say, MOS or Nutrien, for example, they're too far down in their patterns, although they look very similar over the last 2-3 weeks. Those little descending type of triangle moves here onto near-term support, running into the 20-day line with Nutrien. And also, I believe Mosaic was doing the same thing. So, there we go. Yeah, it's a little weaker, but notice it's trying to hold the 200-day and the 50-day line here. So let's go through more of these. Rambus, it to me looks like it's a late stage failed base. It's breaking down. You got a double top type thing going on here along these highs. And so when it broke here, that was a trigger through the 10 and the 20. Now you get a rally back into the 200, which has come into play. And now you're bouncing out the 50. Watch for resistance along the 200-day line. I think it's probably going lower. Northrop Grumman, a failed base yesterday, now rallying back into the 20-day line. End phase energy is holding up. So this one's actually not willing to give it up. Neither are some of the other solars. They're hanging in there. But again, they may simply become the next shoes to drop. So I want to monitor them. And I don't really want to be long them. Okay, I've traded some of them intraday on various signals. But, you know, like the other day, I guess it was Monday, you know, the thing held support at the 10-day line. You know, and so you can short it up here on the breakout failure because that's what you have right now. But it's trying to re-break right now, re-break out rather. We're trading at 311.57, so it's pushing back above this 308.88 left side peak. But that's another one to watch. If it breaks 300 and then the 10 and the 20, then that may become another next shoe to drop. You got the same thing with Lantheus Holdings on the 10 and the 20. Catalyst Pharma is just an infinite PE biotech. And you got Denbury, another oil name hanging up there along the 20-day line. Arista Networks is starting to break down. If we look at it on a longer time frame, it's a little bit double toppy, but you get the breakdown here and the bounce off the 65-day exponential. That's the black moving average there. And now you're pushing into the 20-day line. I don't know if that becomes shortable here. Here's Excelis Tech. This is a double top situation here. Where it failed on the breakout. That was about, what, 2 weeks ago? And so you fail here, and then you run down in here into this area of price congestion. So you get a little bounce, but then it just rolls over. Now you're pushing back up into the 200-day moving average. If you look at this, coming up into it, volume is running 62.3% below average. Looks a little suspect to me. I want to get medieval on this market here, but Albemarle actually is played as a short, so that actually triggered about 5 minutes ago. I'll show you that on the 620 chart, but let's run through more of these. BJ's Wholesale, that can be watched at the 10-day line. Blucora, already a short 3 days ago at the 20. There's CRC. Where am I? Oh, that looks like they... Now we got Camco here. Uranium name, it's holding up. You got a double top peak here at the left side that is at 32.49. It hasn't gotten up that high. You've got this peak here at 28.28. We're trading above 30, but I would watch this. It may just continue to base. I think if there's any thematic in this market that I really like, it's the uranium theme. But if the market's coming down, everything's coming down, and this will break support and then try to set up again. So it's possible it's shortable in here. Let's take a look at the 620 charts real quick. So if we look at CCJ, what do we got going on here? I really haven't looked at this. Yeah, it's just hanging tight. I looked at this a little earlier, and you had a cross, but it's not really giving up at the 20-period line. That's the blue moving average here. But it does have a MACD cross. I don't know. We'll see how this plays out. It's possible if you see another rally up closer to 30.40, it might be shortable. Or if you can use that as a covering guide, 30.40, which is what? 15 cents away, half of 1%. It's possible you could come in on this and give it a shot. So, but again, the market's going to need to break to drag these down. You'll notice yesterday the short side worked so well. Because as Chris was telling me before the webinar, he was able to jump on some stuff yesterday and do pretty well. So even though you did have the big gap down, it was possible to jump on stuff and get short. And yesterday made it feel real easy. And when it feels easy, that's usually when short selling works best. So, watch for that. If the market starts to break, then I think 10-day support here on names like CCJ and some of the lithium names that have been acting well might be something to keep an eye on. So here's some others. Quanta starting to wobble along the 20-day line. Eli Lilly running up into the 20-day line as well. McDonald's, a late-stage failed breakout. You can see here's the breakout here. This was about, I don't know, what, a month and a half ago. You failed. You're sputtering around, bounce off the 200-day line, roll through the 50-day line yesterday, bouncing back to the 20-day line. That might be a short entry right there. So Corteva is an agricultural name. Look at the double top playing out today. If you're using this left side peak as your reference double top high, the high there is 64.03. This morning, the stock got to a high of 64.30 and then reversed, now trading at 63.22. on this chart. So that's triggered a double top entry right here. Then you then use the left side peak here at 64.03 as your covering guide. So it's pretty simple, and that is probably what, couple of percent above where it is now. So Celsius, this one's coming back into the 20-day line. This is one we've been talking about. That's a short entry there. I think these guys are being bought out. That's why it's tight here. I don't know. I'd have to double check that. Here's Arch. This is a Resources, a coal name, ready to bust a 200-day line. These are the some of the lithiums I'm talking about. You can see Lithium Americas. It's in a kind of a double top position along this price resistance over the past 1, 2, 3, maybe 4 weeks. So you get up into these highs, you got to start watching for possible double top short sale entry triggers if it reverses back below those highs. Similar to the Corteva example I just showed you. Iridium, this is a late stage failed base. Look at this big volume breakout right here. That happened 7 days ago, 7 trading days ago, on news that they got a big contract. Interestingly, even though people use their products or product or service, whatever it is exactly, they don't seem to be able to make money doing it. So this is an infinite PE stock. And of course, they whacked that breakout immediately. And you can see here, that was just trashed. So now it's a late stage failed base breakout. What are you doing today? You're pushing up into the 20-day line. That's a short sale entry. So you can see, going through my leaders list, I can find some potential short sale candidates. That's what I'm looking for. Extreme Networks. Here's a breakout here that failed. It's probably double toppy too. Yeah, it's a little bit double toppy. But you see the breakout here that failed. Now you're sitting below the 20-day line. That's in a short sale entry spot using the 20-day line as your covering guide. First Solar is another one of these impetuous solar names that's holding up. 10-day line becomes support for it. If it busts it, that might become a short sale entry. Harmonic, a little bit extended on the downside. Iridium, we already talked about. Let's see. Just going to run through these. I think I've already discussed some of these. ON Semiconductor, that's a double top failure in here. Let's take another look at this. Yeah, you can see you're actually trying to hold some of these peaks, but you're underneath the 20-day line. So in this position, rallies up close to the 20-day line would be your short sale entry spots. Peabody Energy is another coal name. It's wobbling in here along the 10 and the 20. Support at the 50. So short at the 10 and the 20. If it busts at 50, now you've got a secondary short sale entry trigger, and you're off and running if it's going to work. I already showed you Quanta. Looked at Sigma Lithium. Look at Steel Dynamics. There's a nice double top 3 days ago. It's just blowing apart. Target Hospitality, I think we already talked about that. Here comes Vertex, which is a late stage failed base. It also failed about a month and a half ago at the $300 century mark. So it's been working that way. But you see, pretty typical action. Okay, if you just view this, forget the century mark rule, you can also view this as a late stage breakout like that, but it fails. So when it busts the 20-day line here, now it's in play as a late stage failed base. So what happens from there? Well, you bust the 50-day line and you're hanging along the lows in here and around the 65-day exponential, okay? So I wouldn't be shorting it on that necessarily, but now the moving averages are converging, but you do have this area of price resistance. When it first busted the 20-day line, it set up these two peaks. So I'll use those as shortable price resistance. And now as you busted the 50-day line and the 65-day yesterday and all the other moving averages yesterday in one shot, the rally back up into those moving averages then becomes something to watch as a potential short sale entry. So I can blow that up. You can see it's actually stalling at the 10-day line right now a little bit. And that is my my watch list, I believe. Let me look around and make sure. Yeah, let me go through some of these solars as well. So we'll just segue down into my solars group. There you are. And you can see some of these, like Array Technologies, which had a big, if you look at these, some of these names are just really pretty well beaten up. There's Array on a longer term chart. So, it's come up off the lows and it's formed this new little base, but it was a short yesterday at the 20-day line. And it would be again if it rallied up into it. Canadian Solar, same thing. It failed, late stage failed base. We can just call it a base failure type setup. Everybody wants to argue about whether it's late stage or early stage. To me, it's like it's run up for a while, it's formed a base, it's failing on the breakout, it's a short when it fails. And this one was. And you break down towards this low here and you hold, but you bounce right into the 20-day line. So it's a short there again this morning. Dayco is another another one that was a short 3 days ago. It's extended on the downside. Enphase we talked about. First Solar we've talked about. Jinko Solar, this thing looks like it's ready to roll over, frankly. So the market's starting to give it up. We're up 64 on the Dow. And, you know, it made sense. How much were we down yesterday, Chris? Like 1270, 1234, I forget.
Something.
Yeah, so over 1,300, I think, at one point. But anyways, you have these other solar names. Okay, SunPower, they're a residential solar installer. They also, you know, put them on commercial buildings, but they're a solar installer. And you have a double top move. You come straight up off the bottom, and let me show you what these are types of things I'll play on the long side. Okay, where a few days ago, and this was last week, you had an undercut and rally on this day, so that was a long entry. You also cleared the 20-day line, and that was a pocket pivot move, right? No, that would be it here. And then the next day you had this. That was this move, and you break out. Okay, but you're coming straight up off the bottom. So this left side peak is at 27.15. And so now I can use that as a short double top short sell reference point. So we dropped below it yesterday. You're still below it, and right now you're trading at 26.98. So you're coming up very close to it, where you could potentially put out a short if the general market continues lower. Remember, you want the tide moving with you. And so in this case, it becomes a short in here using 27.15 as your covering guide. And again, I'll repeat this once more. When we say covering guide, just like what we mean with selling guide, you have a reference point that is your guide. You can then add 1 to 3% or 0% if you want to run things really tight and come back in again, you know, something sets up, which is what I'll do. You know, that's your choice. But so, you know, 27.15, another 2-3% would take you up another 70, 80, 90%, I guess. I don't want to wait that much. See, I'll just use that 27.15 as my entry level. We're pretty close right now. We're at 27 now. Then I might take a shot if the market starts to break, and then use that as a covering guide. And if it pushes above it, I'll cover it. But then if it goes back below, I'll just come back and hit it again. So you got to make sure you have a lot of day trading buying power too in your account to do that kind of thing. Similar thing with Sunrun. You have a 37.76 peak on the left side here. So yesterday you busted that. You're trying to hold it. You're trying to hold above the 10-day line here. So and that's what it's doing so far today. But right now you are trading at 37.59. So you're 20 cents below that double top peak. Again, just like with SunPower, could be a potential short sale entry. And of course, what you're looking for at that point is the market to break back to the downside, which it's kind of doing right now as I speak. And that's the solar. So that's one area to look at. You know, everything else is just a pile of crap or garbage. I'm sorry. But you can see semiconductors are beaten down. You know, you had like Lam Research, a beautiful short at the 20-day line on Monday. But just everything there is beaten down. If we look at big stock NASDAQ names over here, you can see Alphabet is just getting pummeled. It looks like it wants to break out of this big giant bear flag. Amazon busted the 50-day line. It's pushing back up into it. So that actually puts itself in a short sell position. Use a 50-day line as a covering guide. Apple, same thing there. It's not up to the 50-day line, though. Yesterday, it did trigger a short at the 50-day line. But first, it did so at the 200-day line, which is this red moving average running right through here. So, yeah, that's pretty weak, and that's on huge volume. So I hear all these idiots on cable financial TV talking about, oh, this is, you know, the premier name. You got to own Apple. And it's a great defensive play. No, it's not. Cash is a great defensive play, or short is more of an offensive defensive play. But, you know, the stupidity of these people who go up on TV is quite amazing to me. But I figured a long time ago that most people who go up there are idiots anyways. Otherwise, they wouldn't be there. And I don't have time to waste there anymore. Right, Chris? Neither do you. Anyways, so that's one. Booking, rallying into the 20-day line. And you know, when you look at all of these, Intel looks pretty ugly. Meta Platforms, formerly known as the scandalous Facebook, disguised as Meta now. Talk about cheesy. Cheesy on top of cheesy, but that looks like it's ready for a bear flag breakout. Microsoft looks like it's ready to break to lower lows. That's another name they talk about. Oh, you have to own this name. What these people don't understand, and this is a critical concept that you all need to understand right now, right here, right now, and that is that interest rates are rising. When we had interest rates at 0%, that's when you can justify infinite PEs, because there's so much freaking money out there. It doesn't care what the PEs are. It's just going to fly into the next hot thing. Same thing happened in the dot-com bubble. But PEs will expand when you have easy money policy. When money policy or monetary policy begins to contract, interest rates rise, the Fed is starting to sell off some of their balance sheet. Now you have a situation where liquidity is diminishing, therefore PEs are going to contract. So even though a name like Meta Platforms is considered a value stock now, it was considered a value stock, I think, back up, down in here at 190. Now we're down to 164.70 right now, and it was added to the Russell Value Index, but there's not much value there. So you can see even in Microsoft has not been added to it, but it's also considered, a low PE name. 27.39 times trailing 12. What's the growth rate on Microsoft these days? You know what that is, Chris?
It's been pretty low, hasn't it?
Yeah. So how are you going to justify, a big 27 PE on something that's growing in single digits?
It's just the inflated market that everything's so inflated right now. The P, relative to the reality, and it's part of the bubble that we're seeing. So much money was pumped into the system from COVID, so all these stocks are just way. I mean, look where they were, say, pre-COVID levels, and where they are today. So that's the bubble, and I think that a lot of that needs to be unwound.
Yeah, exactly.
The 1930s are any guide, or 2000 to 2002, and I mean. The thing is, the Fed, he doesn't want to crash the markets, but they have crashed the markets before. I mean, when I say crash the markets come off huge to unwind the bubble. And the NASDAQ was off 78%. And then in 1932, the Dow was off 90%. So we could see a replay of that, because the conditions today are about as bad as they get, macro speaking.
Yeah. Anyways, Microsoft, latest quarter, 3% earnings growth. So there you go. You're paying 27 times for 3% earnings growth. But even then, you look at the estimates, 2023, 10%, 2024, 18%. In a interest rate rising environment, or rising interest rate environment, I should say, that PE won't hold up. So, and I've said this many times before, that QE has created systemic PE expansion. So not only do we get the crazy, innovation stocks with their infinite PEs, but you also have had PE, almost absurd PE expansions in semiconductors, in railroads, in trucking, in industrial names that traditionally, back when Chris and I started in the business, would have 7, 8, 9, 10 PEs normally. Now these things have 30 PEs. And that's an example of a systemic PE expansion. They're not necessarily hot stocks, but because money is free, they garner higher PEs. Those are going to contract. So anyway, let's see. Netflix has also been added to the Russell Value Fund, but that, to me, that was a short yesterday at the, excuse me, at the 10 and the 20. NVIDIA just heading lower. Oracle, that was a great short yesterday at the 200-day line and just breaking lower. I couldn't understand why they were rallying it yesterday. So I watched it on the 620 chart, and it turned into a beautiful short because their earnings growth was 0, and they guided lower. And I was like, okay, and you're selling at 17, 18 times trailing 12. Is it really worth that? When you're looking at negative earnings growth going forward, I don't think so. Qualcomm also busting. Tesla, I don't know what's up here, but I'd watch this for some kind of a shortable, either double top as it moves into this price resistance up here along, say, the 315 level. We'll see how that goes. But anyways, there's some ideas out there with the market up this morning. I've shown you a bunch. So if you want to short, they're there. Give it a shot. Hopefully it's not too obvious right now, and you're going to have to chop around a little bit. So they're going to frustrate you and not give you any immediate love. But yesterday there was love on the short side everywhere. It was an ocean of love, and I basked in it. I soaked in it. I don't know. Maybe that's getting carried away. In any case, it was a lot of fun either way. So that's all I've got. Anybody got any brilliant questions? None whatsoever. All right, good enough. Let's get back to trading and see where this market goes. I think you guys have a good plan, at least based on what I've shown you. And if you're not, a short-term trading short seller, because in short selling, you will have to be active, okay? because you get these nice breaks, you get 15, 20% profits, you take them, they undercut lows, those are your cover signals if they occur. So you're either using a profit objective, getting a sense of how oversold things are getting, covering, and then looking for the next rally to short into. You're kind of looking for something like that now, but you know, unless you're going to do that as a short seller and be willing to be active, unless you do want to try and follow a big trend to the downside, if in fact we start a new bear leg down and we break to lower lows. And usually in a bear market, the later legs down will tend to be steeper and of more greater magnitude on the downside. So, you know, that's what you'd be looking for. But if you do try to do that, then I would suggest, number one, make sure your entries are very tight and done at the proper place. So be patient. Make sure you're at the right spot. Maintain tight risk management, and then take smaller positions so you can sit through the volatility. Anyways, otherwise, you know, if you're an intermediate term trend follower, cash is king. Anyways, that's it for now, you guys. Thanks for showing up. We'll talk to you next week. Take care.
So long, everyone.